Hi everybody, welcome to the S&W Now and When webinar. Today we're going to be talking about wealth management. My name's Nick Travis, I'm a partner in the investment management department at Smith Williamson, and I'm joined by my colleague Luke Brooks, who is a partner from our financial planning department. Today we're going to talk through some of the tax wrappers that commonly come up in conversations with our clients. I'm going to be talking a bit about investment management and what we think, how we apply risk in investment management portfolios, and then Luke will be talking through some cash flow forecasting and how they fit into the financial plans when we're speaking to clients. There will be some time for questions at the end of the session. If you can ask them as we go along, we will try to cover as many as we can when we get to the end. And you will also notice along the way that there's a couple of polls, so do try and get involved in those if you can. A word of warning at the top of the presentation, all of the things we're trying to talk about today are really about conveying the key concepts that we think about with our clients. In no way is this advice, particularly because when we're having the conversations with our clients in the real world, all of the advice that we give is very, very bespoke and is individually tailored to each one of them. So today's all about key concepts. Happy to pick up after the session if anybody wants to talk about their personal objectives. With that, I'm going to pass over to Luke to start the conversation on financial planning.
Thanks, Nick. So my name is Luke Brooks. I'm a chartered financial planner and a partner in the financial planning team here at Smith Williamson. I wanted to start my part of the session today by explaining why wealth management conversations at Smith Williamson start with a financial planner. And that's because of financial planners' unique skill set in as far as we are authorised and regulated to advise on both tax and investment matters. I should emphasise that doesn't mean a financial planner will complete tax returns like a tax advisor or even buy and sell shares like an investment manager. What it means that we're best placed to have an initial fact-finding conversation with a prospective client and to establish exactly what services they need. Importantly, our financial planning team at Smith Williamson retains our status as independent financial advisors. That means that we can advise on and set up different products and tax wrappers for the whole of the market. And I found that's extremely important when taking on new clients that have existing structures in place. As Nick said, I'm going to start by looking at some different tax wrappers and products today. I'd argue that legislation has tightened in some areas and loosened in others. In my opinion, that makes it increasingly difficult for clients to navigate the market without professional help. Increasingly, myself and other financial planners at Smith Williamson talk about a portfolio approach or a patchwork quilt towards financial planning, using different products and tax wrappers to meet our clients' changing needs and objectives. So the first product I wanted to talk to you about today was the traditional pension. Now, pensions are perceived to be complex, but in their simplest form, it's just a tax deferral vehicle. Tax relief is given on contributions made today in exchange for income tax being paid on the income that is taken in retirement. Statistics show that 6 out of 7 higher rate taxpayers during their working lives will be basic rate taxpayers in retirement. And that means that pensions are still great products for so many Smith Williamson clients. It's probably fair to say that HMRC have realised they've been too generous for too long in terms of the level of tax relief they've given away on pension contributions. So the contribution rules have certainly tightened and become more complex in recent years, particularly for higher earners. Nevertheless, there's still lots of opportunities in this field, and pensions still prompt more new client inquiries for Smith Williamson than any other business. Once pension contributions are made, the funds themselves grow tax-free, but importantly, there is no access to those funds until the individual reaches retirement age, which is currently set at 55 at the earliest. It's worth noting that pensions have worked particularly well for our entrepreneurial and business-owning clients. As dividend rules have tightened, they've used pensions as a means of extracting money tax efficiently from their business. Next up, I wanted to look at ISAs, which of course are an extremely well-known product. Incredibly, I still meet people every week who think of ISAs as cash-based savings products that they would set up with their bank or building society. And still I hear today that the rates of interest on offer are not considered worthwhile to committing those funds. Our financial planning team at Smith Williamson and Nick's investment management team have been big advocates of stocks and shares ISAs, so using your allowance to fill up on your stocks and shares rather than cash, as both dividends and capital gains are receivable tax-free forever. ISA subscription limits have become more generous as the pension rules have tightened, and nowadays it's possible to invest up to £20,000 a year into either a stocks and shares or cash-based ISA. The allowance is something that Nick and I use systematically for our clients year in, year out, as a means of building a meaningful nest egg over a long period of time. Indeed, Nick and I share a number of clients who are ISA millionaires, so individuals who have built funds in excess of £1 million within their ISAs, which will be tax-free for however long they hold them. Importantly, ISAs provide full access to funds at any time and without notice, so they combine particularly well with pensions, whereas I've already said access is limited prior to retirement. Moving on to a new product now, lifetime ISAs, which are the government's first attempt at combining the best features of pensions, the availability of tax relief on investments, and ISA's best feature, ease of access. Lifetime ISAs can accept subscriptions of up to £4,000 per annum and benefit for 25% tax relief, which is worth £1,000, on the proviso that those funds are ultimately used to buy that individual's first home, or failing that, to fund their retirement from age 60. Lifetime ISAs are targeted at the under 40s, so they're not appropriate for all of our clients, but they've certainly proven to be popular with our entrepreneurial clients and our sports clients. And increasingly, we're finding our mainstream clients using lifetime ISAs as a means of passing down wealth to their children and possibly even their grandchildren in a responsible manner. It's worth pointing out at this stage that actually relatively few firms have chosen to embrace this new particular product, and I wanted to make the point that Smith Williamson was one of the few providers that does. Moving on now to junior ISAs. These have been available for a few years now to those under the age of 18 and have been commonly used by our clients as a means of passing down wealth to minor children. Importantly, junior ISA funds are inaccessible until that child reaches age 18, and at that point the junior ISA would convert into a traditional stocks and shares ISA, with the ownership passing effectively from the parent to the child. The subscription limit is £4,260 per annum, but importantly this is linked to inflation and is increasing to £4,368 per annum with effect from the 6th of April 2019. I recognise that subscription limit is not particularly large, and where our clients have wanted to be more generous than that, we've taken the opportunity to combine junior ISAs with bare trusts and in some instances pensions as a means of parents and grandparents passing down wealth. Beyond the pension and ISA regime, lump sum investments into offshore bonds provides tax deferral opportunities for higher rate taxpayers, as well as estate planning opportunities in terms of passing down wealth, that proves to be excess to requirements. We've seen an increased use and appetite for offshore bonds in recent years as a means of providing additional diversification of tax wrapper, particularly in this increasingly uncertain political time. We see that clients are keen to hold as many different tax wrappers as possible to give them the best possible chance of adapting to changing tax legislation. As independent financial advisors, we also work with specialist businesses who provide off-the-shelf venture capital trusts and enterprise investment schemes, which give our clients tax reduction opportunities on the proviso they're willing to accept higher levels of investment risk than we might commonly expect to be associated with our clients. Finally, Smith Williamson do offer advice on bespoke structures like family investment companies and private OICs and unit trusts. If that is a type of thing you would like help with, then please do ask. Moving on now to Nick.
Okay, so I'm going to try to cover a bit of an introduction to investment management, and hopefully after I finish speaking you'll understand some of the key concepts that we consider. So I'm going to start today with a graph that shows the effect of inflation. So what we're looking at here is the effect of inflation on £100,000 over a 20-year period. And what it's showing is that the actual purchasing power of that £100,000 over the long term drops to around about £58,000, which is a pretty marked difference. And it's for this reason that we have to do something a bit more smart with our money, so we don't erode value in real terms. Now, over the short term, inflation isn't that much of a risk. So if one of our clients has a pot of money and they want to do something like buy a house with that or go on an expensive holiday, we would encourage them to keep that money in cash because they shouldn't be taking market risk with it, and the effect of inflation is actually negligible in a short period of time of maybe a year. But as you can see, as people start to think about putting money aside for maybe retirement or long-term investment, they can't afford to ignore the effect of inflation. They have to do something with their money to make it work harder. And that's where we start to think about investment risk, because to make any real return, you do have to take some level of investment risk. The level of risk somebody might take depends on a huge amount of different factors, including things like their age, how long it is until they want to retire, what's their investment time horizon, and just things like personal appetite. Some people are naturally risk averse. And when we speak to our clients, we think that the best way to adjust risk in a portfolio or an investment is by changing the mix of the assets that they hold. So it might seem obvious, but for a client that wants to take lots of risk, you hold a high percentage of higher risk assets. And for a client that wants to take less risk, you have a higher percentage of lower risk assets. When we're talking about risk, what we're really talking about here is volatility. So if we say an investment is risky, it is more likely to move up quickly, but then also down quickly when markets move. And when we say something is less risky, it tends to be much more stable in its returns profile. So a very risky investment, we would consider equities, and a less risky investment, we might consider something like bonds. So as you can see there, a lower risk investor can expect more bonds in their portfolio. Now, what does that look like in the real world? So what I've done here is I've just shown an example of a portfolio that's a medium risk portfolio. So it sits in the middle of the bar chart that we've seen there. And I'm not going to go through it in any massive detail. I'm just going to pull out a few of the characteristics. So as I've said, this is a medium risk portfolio. It sits right in the middle of that risk spectrum, and therefore has about 64% in equities. And you can see that there if you add up the 27% in UK equities and the 37% in international equities. Now, the UK equity portion of this portfolio is held directly, i.e. we're buying individual stocks and shares. You get an exposure to one individual company there. And one thing that's often misunderstood as people start to invest into this type of investment is that when you're buying a UK equity, you're not buying a company that's just UK focused, you're buying a company that's UK listed. So, for example, a company like Unilever, which is UK listed, has products like Domestos, Dove, Surf, Walls, Flora, that they're selling globally. And in fact, most of the portfolio that you can see there in the UK equity portion has most of its income coming from overseas. So this is, even when you're buying a UK equity, and we do that, a lot for our clients, they're buying global growth in these types of brands. One of the other types of investments we've got in there are collectives, and we've got two types of those. We've got active collectives and passive collectives. A passive collective is basically where you're buying a fund that tries to mirror an index, or an index like the FTSE 100 or the S&P. You can see in there we've got FTSE 100 iShare. That's a low-cost way to track what the biggest 100 companies in the UK are doing at any one time. There is no one behind the face of that individual fund making investment decisions. It simply just tracks the index. Whereas an active fund, for example, the Findlay Park American Fund, has a manager sat behind the fund making day-to-day decisions, and we hope that they would outperform a passive index. And I suppose that's where our expertise come in. So we have over 500 investment meetings every year. We're constantly reassessing whether these portfolios are holding the right assets. We're always looking for new opportunities so that we can drill down and have a portfolio that looks like this as an indicative for one of our clients. One of the things that I wanted to point out as well on this page is the yield. So when you buy an investment or hold a portfolio, you should expect to get two types of return. One type of return is income, so they're dividends and distributions from funds, and they should be quite steady and quite reliable. The other type of investment return it should receive is capital return. And that basically just means that you buy something, you hope that the price goes up so that you can sell it at a higher price. That's capital return. Investments tend to have varied levels of yield, but when the yield is very low, it's because you're expecting to get a larger amount of your return from the capital gain. This portfolio, as you'll see on the very right-hand side at the bottom, has an overall yield of 2.5%, and as you'll see above that 2.5%, the individual yields vary greatly between the different types of investments. As you'd probably expect, most of our clients don't particularly care how they make their return, so they look at a total return. They look at the return from the income plus the capital over a longer period of time. So what I'm moving on to now is just to show in reality what different levels of investment risk have returned in the past. So, these are all historic returns. They shouldn't be relied on for sort of future growth, but they're a good indication of how things have gone. The first line I've got here is risk-free. So this is somebody that holds cash, doesn't make any investment, take any investment risk at all, and just wants to make sure that the amount of money they have is completely protected. And they, as you can see there, return 2.21% on average over that 15-year period, adding up to 38% over the longer term, which seems fine when you're not taking any risk. However, if we overlay that with the cost of living, so if we put onto this the retail price index, which is basically just an indicator of the cost of things that people buy increasing, what you will see that in real terms, by not taking any investment risk here, this investor has lost money in real terms. And that's back to the point where we do need to take some investment risk to get some real return. So let's go to the other extreme. So this is a full equity investor. This is a passive investor. You'll remember that means there's no investment manager behind the scenes making a decision, who just wants to track the FTSE 100 index. And the yellow line indicates how their return profile would look. Obviously, a hugely more varied return on different time frames. It's much more volatile, and that's the trade-off you make for having the potential to earn more in your investments. Really importantly here, you'll see that in 2008, somebody that passively held the FTSE 100 will have suffered a peak-to-peak loss of around about 40%, which at the time is quite scary, as you'll see. If they held, they would have recovered a lot of that, but at the time, it pays for a risk taker, investor, to hold their nerve and hold on to their investments. The next few lines that I'm about to add are if we look at more actively managed funds. So these are Smith & Williamson actual returns from actual portfolios in different risk categories. And the risk categories, as I've said before, equate to different client needs. So the first one at the bottom that I've added is a cautious investor. So the aim of this investment profile is to limit downside when markets turn bad, but to slowly increase value in real terms over an extended time period. And you'll see that in 2008, actually, there was a very negligible amount of downside, whilst the FTSE 100 had dropped about 40%. In return for that, as goes with the theory of this, that investor only has returned about 4.27% in total on average over that time period. Further up the graph, you can see 3 actively managed Smith & Williamson past performance lines for 3 different investment categories. Now, the reason I put them on all there together is to highlight that actually you'll notice that the investment performance behaves in a very similar way. The difference being that the higher risk portfolio returns are amplified both on the upside and the downside. And the reason for that is simply that those types of portfolios have a higher degree of equity in them and therefore move down more quickly when markets turn and move up more quickly when markets are positive. So that's a quick canter through some of the theory behind investment management and going through to what that looks like in historical returns. I'm now going to pass back to Luke, who's going to talk about the lifetime cash flow planning and how that fits with the investment management theory.
Thanks, Nick. So as Nick just said, I'm going to spend the last few minutes of the webinar taking an opportunity to introduce you to a piece of financial planning software called Voyant, which we've been using at Smith & Williamson to drive the deep, engaged conversations with our clients about their needs and objectives and how best to achieve them. Within financial planning at Smith & Williamson, our clients ask us lots of questions, and they're often focused around the concept of, have I got enough? Can I afford to retire? Can I afford to make that gift? Can I afford to pay for my children's wedding, to pay for their house deposit? Can I afford to pay for my children's or grandchildren's school fees or university fees? What we do at Smith & Williamson is use financial planning software to drive great conversations about changing income needs at different stages of their lives, the impact of inflation, which as Nick has shown can be the biggest threat to a retired client, the impact of changing investment returns, and finally the impact of using different tax wrappers. So this first chart I wanted to show you is known as the lifetime cash flow. This seeks to explore our clients' changing income need across 4 different phases of their lives. If you look at the bottom axis, you'll see a period which is highlighted in green called pre-retirement. These are our clients' final retirement years, final years in a run-up to their retirement whilst they're still earning, generating more income than they're spending on sort of living costs and taxation. Moving on, we look at the active retirement phase, which is highlighted in orange. These are the early retirement years, which are generally still quite high spending periods for our clients because they tend to travel a lot, but tax costs are often much, much lower here. Increasingly, we find that our clients in their late 70s or early 80s go through a period of lower spending. And at Smith & Williamson, we've come to know that as the inactive retirement phase. We find that clients have often done their travelling and their income needs drop dramatically. And then finally, in the later life period, highlighted in green, we see quite a big spike in our clients' need, where they need to sort of pay someone to pop into their house each day to make sure they're getting in and out of a shower and having a hot meal, or at an extreme, sort of paying for full-time residential care. Clearly, all of our clients are different, and the amount that our clients expect to spend and the length of these different phases change dramatically. We'll work with our clients to try and understand how they see their lives play out and then build their lifetime cash flow in a bespoke manner for them. This particular individual is a very high earner, earning more than £1 million a year in the run-up to their retirement, but paying lots of tax because of it. And ultimately, they are also a high earner in retirement, and therefore one of the most important questions that we can answer for them is whether or not their accrued assets are enough to meet their needs. So this second chart explores the changing value of our clients' liquid assets over those different life phases that I've just spoken about. What we'll see here is an increasing asset base in those pre-retirement years as a client earns more than they need and is able to add to their pensions, ISAs and personal portfolios. When the active retirement phase begins, it becomes clear that we're spending more than the portfolio is generating, and their liquid assets start to fall away. And then with the shallower fall as we enter that inactive retirement period, which, as I've suggested already, might be a lower spending period for our clients. Importantly, what you'll see in those final years is a very steep decline in our clients' asset base as they have to sell significant assets to meet those later life costs. Now, we find that this particular chart is extremely useful when considering the level of risk that our clients should be adopting within their investment portfolio. This particular chart presupposes a return of 5% net per annum, but we would sit with our client with these charts on a plasma screen and play out different scenarios to look at the changing impacts of higher spending needs, higher or lower investment returns, indeed longer life expectancies. You'll see here for this particular family we've modelled to age 90, but their assets are almost exhausted at that point. If we extended the period of analysis, clearly the funds would run out, and that I would expect to be a concern to them. It's really the ability to sort of undertake this sensitivity analysis with this model in front of a client that I believe sets it apart from any other type of financial planning software I've seen. It's proven invaluable to Nick and I when taking on new clients and also when reviewing existing client strategies. Importantly, and I can't labour this enough, importantly, like any form of financial modelling, we know that the projections won't play out perfectly in reality. So we talk to our clients about the model being a living document, something that we will go back to time and time again over the years as we review their portfolios, as their circumstances change, as market conditions change, and of course, as tax legislation changes. That's all I wanted to say on the model, so I think it's time to sort of step forward and take some questions for the final minute or two. So looking at the questions that come through, I'll take this first one. It's which is better, Luke, saving into a pension or saving into an ISA? That's a common question we've had lots over the years, and I guess like anything, the right answer is going to be tailored to that individual's position. Generally speaking, as we said, we tend to find that clients who are higher rate taxpayers during their working life will be basic rate taxpayers in retirement, and that tends to make the pension the more efficient route. The ability to claim tax relief at 40, 45%, or in some instances 60%, and perhaps pay no more than 15 or 20% on the way out will make the pension more efficient for most people. But of course, as I said already, when making a pension contribution, you are giving up access to those funds until retirement. So there is a real trade-off here. We certainly still see lots of people who would prefer to favour the ISA over the pension, maybe committing more to pension later in life. Nick, any questions you want to take?
No, well, I actually think that's all we've got time for. So I think if we wrap up there, we'll address the other questions offline.
Okay. Thanks very much, everyone. Thanks for listening.